Right. Hello, and thanks for joining us again for Max Financial Services Planning Tuesdays. Today is going to be a little bit different since it's the beginning of the year. Kind of to set the tone for the rest of the year, what we want to talk about is 12 predictions for 2016. We're going to talk about 6 financial and 6 non-financial predictions that will have an impact on your situation this year. So one of the things that has led me to do this is over the last couple of years, I followed various fund managers, various economists with their predictions, but it always seems like they're permeables. Every year is going to be a great year. 2015 was one of those years in particular. The market sucked. Meanwhile, most of the economists predicted there was going to be a really, really good year. So this whole notion of it's always a great year to invest is a fallacy and did not really match up to the more cautious tone and the more cautious undertonings that we're seeing in the markets. And voila, that is why we're doing this today. So 6 financial predictions for 2016. Number 1, US GDP will once again be tepid. We're expecting a economic growth of less than 2%. We've had this over the last 5 years or so. We pretty much had a recovery, but it's a recovery that has gone nowhere. This year, I don't expect it to be any different. For the most part, we do expect it's going to, Q1, Q2 will average about 2%. And then possibly towards the end of the year, as things do start to slow down a little bit more, we might even have a recession Q3 or Q4. We are taking a look at it. It's going to be one of those things that people are going to be talking about. So let's see. One of the things to keep in mind with that, though, is if you take a look at Canada, if you take a look at a lot of the other developed markets, they've already been in a recession. So it's kind of like one of those things like 2007. Is the rest of the world going to drag us down? I personally think so. With the economy being tepid, prediction number 2, inflation is going to remain low. Inflation is going to remain under Fed's 2% target. Primarily for 2 reasons: the lack of wage growth and low energy prices are going to keep a lid on all of the input costs on prices, and thus low inflation. With those 2 things, one of the things that's going to come out of it is perhaps the Fed may not raise rates, as everybody really believes that that's going to happen. That's a topic for a different day, simply because we can talk about it for a couple hours as to why or why not raise the federal funds rate. But for the most part, the 2 things that the Federal Reserve is looking for, inflation and economic growth, and both of those are going to be really, really tepid this year. If anything, on the inflation side, I think we're going to have more pressures on the deflationary side, with prices dropping, once again, with energy prices going down and China's economy slowing down. Number 3, oil prices are going to average under $45 a barrel. Perhaps we might have a spike up to 50 or 60 if geopolitical issues break down. But for the most part, towards the end of the year, we expect average oil prices to stay under $45 a barrel. If they stay that low, once again, it's going to be good for industrial producers. It's going to be great for consumers. But if you're a company dealing in energy, it's not really going to be great news for you. Number 4, S&P 500 will finish flat or down for the year. And more than likely, we will see a decline of about 15% or more. It's one of those things. Technicals are breaking down significantly, and even though we came up with these predictions a couple of days ago, so far we've had a pretty rocky start in the first 2 trading days of the year. Volatility is expected. Volatility is probably going to be here for a while, and we'll likely have a sell-off at some point. If anything, I do believe that we're starting to see signs that the bull market in stocks is done, at least for now. Number 5, and this is really where I'm going to differ from a lot of people. I fully expect the 10-year U.S. bonds to finish under 2% in an overall flattening yield curve environment. So the Federal Reserve raised short-term rates. However, since then, long-term rates have actually come down a bit. Really what's happening is on the short term, the rates are going up. On long term, the rates are coming down. It leads to a flat yield curve, which is actually a precursor for a recession. Simply because people are not really that optimistic about the economy, either in the long term or in the short term. They're really going to be indecisive. And at that point, well, recession. And number 6, U.S. economy eventually enters recession during Q3 or Q4 of 2016. Two factors that go into that. Number 1, corporate earnings have already been flat towards the past couple of quarters, and more economists, more and more Wall Street analysts, and more CEOs are coming down and they're revising their earnings growth down. One of the things that's really going to be interesting to see is all of these companies that have increased their earnings through financial engineering, which primarily included debt-financed stock buybacks. What's going to be happening with them? Are they going to start unraveling those, particularly in situations where a company borrowed money in order to buy back their shares because they didn't know anything else, or they didn't have any other uses for money, and since it was so cheap to borrow, they ended up buying their stocks, and the stocks ended up going down in price. We call it, with our clients, we kind of equate it to, you're going to go borrow money on a credit card in order to go gamble, and you lost. Now a lot of those companies, they owe money for stocks they're completely underwater on. There's a couple of stocks in particular, which I'm not going to mention on this blab, but we can talk about them in a little bit more detail. But they've lost billions of dollars buying back their stock, and the stock went the other way. This is going to be one of those situations that's probably going to start unraveling 2016, and particularly if the markets do poorly for the year. We're probably going to see some investors' calls for the heads of the CEOs, and perhaps a lot of those companies are going to have to go back and try to raise money again for continuing operations. So that's that on that front. So once again, to sum it up, the 6 financial predictions: US GDP is going to be under 2%. Inflation is going to remain under 2%, and if anything, we're going to have more pressures towards deflation. Oil prices are going to average under $45 a barrel. We may have a spike if the situation in Saudi Arabia and in Turkey, something like that, breaks out a little bit more. We might have a short-term spike, but towards the end of the year, just the 2 factors: we have too much supply, we have too little demand. Prices are going to drop, or there's going to be a lid on those. Number 4, S&P 500 is going to finish flat for the year, and will likely have a sell-off of 10-15% or more, which may start signaling an end to this multi-year bull market. Number 5, the 10-year U.S. bonds to finish at 2% or under in an overall flattening yield curve, meaning long-term bonds rates coming down, short-term rates coming up as the Fed hikes rates, eventually leading towards an official recession in the United States, Q3 or Q4 of this year. So that's on those. A few more non-financial predictions that may impact your investments. Number 1, the White House will be more concerned about social issues like gun control and climate change than about big issues such as national security, the economy. Today, we've already started seeing signs of that. President Obama is talking about executive actions towards curbing the amount of guns sold and licensing firearms. Meanwhile, I haven't heard anything about ISIS. Number 2, Saudi Arabia and Turkey bring home violent protests over their support of terrorists. I think it's an opportunity to short both the Turkish markets and the Saudi Arabian markets. Saudi Arabia and Turkey have been supporting ISIS. It's pretty much a known fact, except a lot of people really don't want to talk about it or don't want to mention it. And now with the Saudi executions of Shiite leaders and of Turkey's ongoing support of processing ISIS's oil money and protests in Turkey, those are the 2 next areas where I think it's really going to start having a breakdown in the Middle East. Overall, probably going to be bad for the stock markets. And if you're opportunistic, you might see a couple opportunities there. Number 3, another record-breaking year for firearm sales as President Obama pushes more gun control. Great news for Smith & Wesson and Ruger. Once again, I typed this a couple of days ago. Today, President Obama signed the new executive actions into law. Well, not into law. He signed the new executive actions to shove it down ATF's throat. And both Ruger and Smith & Wesson. Smith & Wesson was the top performing stock for the day. It jumped, I believe it was over 10%, 10.52%, and Ruger was up, I believe, about 5% or so. So once again, President Obama, even though the more he wants to control guns, the more guns that he sells. Salesman of the century. Number 4, Ukraine will still be a mess. There will be more uprisings by the people against the Kiev government. There's been more and more corruption, and the newly installed president in Kiev, he has a worse approval rating. He has a lower approval rating than the ousted president that was Russian backing. So that's going to be a hot spot. It's developing. It's going to be really a question of how much the media is going to cover that. Once again, Ukraine already defaulted on Russia's debt to Russia. IMF is still lending them money. It's a mess. It's probably going to get worse. Number 5, Hillary Clinton narrowly wins the Democratic Party nomination in light of Bernie Sanders' rise. Donald Trump is going to secure the Republican nomination. It's almost inevitable. What is funny about Bernie Sanders is, I mean, he's raising a lot of money from grassroots, and I believe his fundraising beat out what President Obama raised himself when he was running for president. So it's going to be interesting, but I don't think Hillary Clinton is going to be a shoo-in. But I think at the end, she will be the nominee. And number 6, Republicans take the White House with President-elect Donald Trump. That's going to be my big one. And I think it's going to pan out. 4 years ago, anybody who knows me, I was a big supporter of Mitt Romney. Pretty much from the beginning, I called it he was going to be the nominee. We got screwed a little bit on by Hurricane Sandy and Chris Christie's bro hug, which would have probably ended up in a President Romney. But short of anything like that happening, and as the world falls apart, the more Donald Trump looks like, hey, you know what, that guy was right. Net should probably be good. One thing to keep in mind, though, it's a little bit of a side note that just came back to me, is typically, if you look back over the last 80 years or so, the third year of a presidency is typically one of the best performing for the stock market, with an average, I believe, is right around 11%. This year was the first year in a long time that we actually had a negative year for the stock market during a third presidential year. So there goes that out the window. And I think this year's probably going to be bad as well. And kind of like for the same reasons, people, as the world was falling apart in 2007, people didn't want another Republican. Same thing that's basically happening right now. If the economy starts unraveling a little bit more, people are going to want change, and they're going to go to the party not in power, and more importantly, we're going to go to a candidate who's seen as being from the outside. So there you have it. You have 6 financial and 6 non-financial predictions for 2016. Throughout the year, we'll be tracking them to see how we're progressing towards those resolutions. If you have any questions, feel free to reach out to us at any time via email. Once again, Maks Financial Services, MAKS Financial Services. And at this point, we'll open up for questions and pause the recording.
Listeners would like to know a couple questions. If you are elected to be president of the United States, what would your vision look like for housing, for the housing branch of government? Going along those lines of consolidating Fannie Mae. Number 2, what would you do or like to see happen to help more families get into homes or be able to afford to purchase a home? And nothing. Those are my 2 questions.
Yeah. So, I mean, it's a really good question, though, because, I mean, arguably you can make thinking back to 2007, 2008, it's like, well, how did we create those issues? How do we get into the great financial crisis? And you can make the point that, okay, yes, I mean, it was a lot of greedy bankers. It was bankers who really didn't know what the heck they were doing and applying leverage. But at the same time, what about the people who should not have gotten the loans in the first place? And I remember, I mean, so we immigrated here from Russia back in 91, and it was quote unquote the American dream that everybody's going to have a house with the white picket fence and everything. And one of the excerpts from The Big Short, from the book we're listening to, is there were people who were making $14,000, $15,000 a year. Meanwhile, they had a $700,000 mortgage.
Yeah.
I mean, like, who in their right mind? I mean, how has it happened? And I mean, yes, you have Barney Frank, I mean, who was on record basically saying, hey, we know that Fannie and Freddie are taking on garbage loans, but house prices haven't gone down. So let's keep on giving them to them because it's the American dream. I mean, everybody should have a mortgage. So, I mean, where do you really draw the line in the sand between what is financially responsible and what is the right thing to do that, well, you know what, not everybody deserves that, or it's like, and particularly as debt numbers are going up.
Well, and that's just it. And I would have all the time. Hang on. Sorry. I would have lenders come in, and I don't know why my thing just went blurry. Or
your autofocus.
Yeah, my autofocus
in front of the camera. It should refocus out and move it out there.
Come to me. No, it's not working. I'll mess with it here. But I had numerous companies come into my office and they would say, hey, Jason, we can do the stated income for that borrower. We can put that deal together. And I'd say, hey, man, I don't know about that. You know, it's not really good to put that loan together. The customer, though, the client would then, if I showed any type of hesitation whatsoever, similar to maybe what you may have experienced through maybe suggesting a certain stock or something like that. If you've got somebody else suggesting, hey, I'll do the loan for you. If Jason won't do it, then I'll do it for you. Then people get wrapped up into this whirlwind of, well, I don't care who's providing the loan. As long as I get the loan, I'll move into the house and I'll worry about the consequences later. Or I may not even stay in the house long enough to even worry about the consequences because I'll stay in it for 2 years. I'll sell it and buy a new one. So there was this euphoria or panic. I don't know what the right adjective is there, but there was this sense of, well, if Jason won't do it, then somebody else will. And when I first came in the business, there weren't that many of us in the business.
Yeah.
And then in 2005, I saw nothing. I go to the grocery store and I would see or hear people 2 aisles over discussing, hey, I can get that loan for you, or I can do this loan, or I can do that loan. And it was kind of like everybody was in the business.
Yeah. Because
it was easy money, I guess, or whatever, but they weren't taking it seriously.
But what do you think of the issue of this? I mean, like, we have clients who are in their 60s, 70s, 80s, and when they went through getting a mortgage, you go to the bank, you give them all your financials, and then there's somebody at the bank who makes the decision, hey, do I want to give you the money or not? There was no such thing as now where you have the originate and sell model where arguably, I mean, a mortgage company doesn't really care one way or the other. They have no long-term vested interest in seeing you pay your mortgage back because they're just going to flip it to somebody else. It's going to get repackaged into CLOs. It's going to be repackaged to bonds. Then that's going to be flipped into CDOs. And then ultimately, a lot of it's going to go back to Fannie and Freddie. Yeah.
Well, Fannie and Freddie even had a stated income deal.
Yeah.
So they were just as guilty as anybody. I will say this. There were, although not enforced, there were, checks and balances, if you will, put in place through broker agreements. So if I originated the loan and then that loan was sold, if that loan bellied up for one reason or another, I was on the hook for it.
Now, was there a time frame that you were on the hook for, or
like 6 months? Okay. So it was mainly for like first payment defaults, maybe some inaccuracies, maybe, whether it's a home that's owner occupied or investment property, that sort of thing. So yeah, there were checks and balances, but were they enforced? No, not really. And they really weren't checks and balances because they really weren't because they weren't enforced and because they were such short-term deals. So, I have been caught quite a few times, not caught, but exposed where I closed a loan, customer kept the loan for like 3 months because the market was so hot, especially here in Phoenix. They would sell the property for a $50,000 profit in 3 months. So you had a short payoff, an early, payoff. Then that lender comes back to me and says, "Hey, you got to pay back your commission on that deal. We didn't keep the loan long enough for you to earn that commission." And so I'd have to pay back commissions. Not because it went belly up, because, hey, they got a better offer because it was so hot and they sold the property and walked away with some cash.
Yeah. So here's the question. Has anything changed in the mortgage market since then? I mean, I know you hear talk about that market's froze up and then you need to be completely prime. But then recently you've been coming across, hey, you know what? Let's lower the minimum score requirements. Let's open it up to more people. So are we just recreating another bubble?
We could definitely fall into that trap. There's a place for every single loan. There's a place for stated income. There's a place for any risky loan. Mm-hmm. That's why we have hard money. It's the matter in which we determine that risk. And determining risk in lending is a moving target. And so, I think if you have a 50% loan to value and you have somebody who has established business for the past, 5 years, 2 years, 3 years, whatever, past that point of, traditional collapse of a business, and they show like, $1 million in sales and receipts, but they only show a gross income of 20,000 because they write everything off. Well, maybe a stated income in that situation might fit that person at a 50% loan to value, right? Because I always like kind of, I don't know, I kind of struggle with the whole idea that we're going to look at somebody's past 2 years of income
mm-hmm.
and determine whether they're going to pay something in the future. And I know the past can kind of somewhat predict the future, but there's also situations where people, the business is established, it's now humming on at a, steady click, but for tax purposes, they write things off and things like, so you're telling me they won't adjust their tax returns to show that it's affordable? Because there are some common sense things that I think can happen. I don't think we're going to go down the road of default. One of the best performing loans is a VA loan. That's 100% financing. And that is because we look at the debt to income ratio and the affordability of that veteran
mm-hmm.
differently. We look at the spendable income. Okay. So we take out the taxes, we take out insurance, we take out Social Security, and then based on an IRS calculation, we take out what the average electric bill is for that square footage of house, what the utilities are, that sort of thing. And we take all that out, and they have to have a disposable income amount of X amount of dollars before they can be approved.
Yeah. And just a plug, I know this is something that we talked about quite a bit more in depth during our last blab that we actually did on mortgage refinancing. So click on the profile. It's going to be one of the last ones with Jason. Definitely worth your time reviewing, and we'll be doing more in the future on those as well. But continue.
Yeah, absolutely. Thanks for that plug. So, I think that we just have to look at it from a different angle. We're still kind of caught on, okay, a 45% gross income debt to income ratio, and FHA currently is at 55%. So somebody with a 55% debt to income ratio, gross, not net income, but gross income, qualifies for an FHA mortgage, even under the qualified mortgage rules that went in place earlier, in 2015. So, I think there's definitely some improvement that can be done there, and because of that, I don't think that we'll go down that same road again. But if values
probably not at the same quantity per se, because I doubt you can get an option arm mortgage right now.
Yeah, nobody's doing it. The other thing too is that companies were paying just a ridiculous amount. I'm not saying ridiculous amount. I shouldn't say that, but people were making a ridiculous amount of money at their jobs. Now today we have the underemployed.
Yep.
Right. So people had a lot of disposable income. So there were a lot of people making a boatload of money who felt that that was going to continue and they were only going to make more money in the future. And that had to be corrected as well. Maybe, I don't know, we can make an argument that it didn't need to be corrected. But so because income hasn't kept pace with values and everything else that goes into a mortgage, I don't know that we'll go back into that frenzy again. Maybe. I certainly hope not, because I don't want to go through that pain again.
So then here's the question, though, is so one of the things we heard from the 07, 08 collapse is that people were getting mortgages and they're putting no money down on it. And we should go back to you need to put down 20%. Can you get a mortgage right now putting down 2, 3, 5%?
Yes. Yes. So 3% minimum. 3%.
Okay.
680.
But anything really changed?
Well, yes, because you do have the qualified mortgage rule. You do have a debt to income ratio at 45 where it was 60%. Mm-hmm. You do have reserve requirements that in case you were to lose your job, not in all cases, because if you have really good credit, you tend to have, reserves and you have a handle on your credit. We don't have the 80-20s and some of the other kind of creative financing kind of rules out there. It's pretty much
the 80-10-10s and the 80-15-5s.
Right. So, that's why there's slight differences that make the outcome a big difference. And it does build a good foundation. I mean, the loans that are going on the books right now are good loans. Every loan that we do right now, we check the income against the IRS. Mm-hmm. So somebody, even a W-2 employee, right? They've been in the same job making, $20 an hour or whatever they make, file their taxes, simple, 1040 EZ forms, whatever. We check that the tax returns that we receive are the same ones they give the IRS, even on those people. So the integrity of the loans is a lot better now than what it was. Before it was like, hey, give me your pay stub, last year's W-2, you're good to go. Right now,
there is no verification of that.
No. They would call and verify. Hey, you employed? Yeah, we're employed. Okay, cool. But they would say, hey, how much does he make? There was none of that going on. So, which just lent itself to the potential for fraud.
That's amazing.
Yeah. So, but because it was so competitively fierce in the business in the arena, you either did it or somebody else would. It was kind of just that atmosphere, and that was bad. That was definitely bad. Now, lenders are not opposed to saying, "Hey, take your business somewhere else."
Amazing.
So there are some changes, I think, that don't lend it to that frenzy that we had back in early 2000.
And like I said, and I think really it's around. It goes back to kind of the roundabout conversation we're having. Is like, well, at what point do we have the social contract with the American people as to, hey, everybody should have a house? Versus at what point are we going to ignore the freight train coming your way and just put your blinders on? It's like, where's the responsibility lie? And I don't know.
Well, lenders now are really evaluating that and saying, hey, not everybody deserves a house.
Okay.
There are just certain people that just don't deserve to be in a house. That's just the bottom line. They may think they deserve, but they don't. They haven't shown the maturity to own a home. So, and a lot can be said about that with credit. I mean, right now, if you have somebody who lives at home who wants to buy a house, but they live at home and they've shown no ability to save money, have a 401k, have any type of savings in their life, and they're not paying any rent, and then they want to get into a house that pays, the mortgage is $900 a month or $1,000 or whatever it is, there's a thing called payment shock. And lenders look at that now and say, hey, look, you haven't shown any proof in the past that you're making a payment of anything at all. You haven't shown, because you're not making that payment, you haven't shown the ability to save any money. So why should we lend you money? So lenders are looking at those things because there are gray areas within mortgage underwriting. Fannie Mae, Freddie Mac want it that way because they want people, politically correct. They want people to be in the home, and they want us to use prudent underwriting. And you can define prudent however you want. So they want us to kind of push the envelope, but at the same time, they don't want us to push the envelope to ridiculousness. I guess if that's a word. Because we in fact, I just saw some articles last month, end of November, where politically they want lenders to loosen up the guidelines.
Okay.
Wells Fargo just recently, I think it was November or October, took their credit score requirement from 620 and bumped it up to 640. So they actually tightened it because they said, hey, okay, they've actually gotten fined a couple times for not using prudent underwriting from their HUD, and their scorecard goes down. And when their scorecard goes down, the margins on the deals get tighter. They don't make as much money. So, and they also restrict the type of programs that you can offer consumers. So that scorecard is a big deal for lenders, the HUD scorecard. So prudent underwriting, they say, okay, well, if you're going to hit me and ding me for something that you want me to do, then you turn around and penalize me for it, well, then we just won't do it. And so you get this jostling back and forth of who's right and who's wrong.
But if I'm not mistaken, Wells Fargo has typically been a more conservative lender or so. They're positioned themselves that way.
Yeah, they have. Especially in the second mortgage department or whatever. But they did drop it down to 620, and then they raised it right back up.
And that's for just straight regular mortgages, or is that for like FHA type loans?
FHA.
Okay.
I don't know. I don't know on their conventional side. I don't know if they really have a minimum credit score. Conventional side is a 620 because you can't. If you put more than 20% down, you can go below 620.
Okay.
But for purposes, mortgage insurance purposes, you need a minimum 620 credit score. So anything less than 20% down, you typically need a.
Okay.
Unless you do a second mortgage or something like that.
Yeah. Good to keep in mind.
Yeah, absolutely, man. But I want to get your take on the candidates because I Trump says, "Hey, we're going to make America great again."
Yes, we are.
I don't know how we're going to do that, but we're going to do it.
So actually, his proposals, particularly, most of them basically want to drop taxes, but it really kind of goes back to the question of, well, is it going to be tax neutral? And well, that depends on your definition.
Right.
Of what tax neutral is going to be. Pretty much most of our proposals is it's going to cost us more money now in order to kind of jumpstart things. But that's part of the reason why we got into the troubles as we are right now. I mean, number one, it's, well, you do have a huge government. I mean, the size of government has grown every single year. We have massive debt, and that could be a whole separate other topic. But I think to kind of help the economy, it's about just really bringing certainty to the market. And the markets really don't have certainty. We don't know what the new legislations are going to be. And it doesn't almost matter who's going to be in the White House, as long as we basically, once we know who, the markets will typically adjust to those people. Right. And historically, I mean, believe it or not, the markets have done better under Democratic presidents than Republican presidents. But then that's also that's forward. I'm sorry, that's looking back. That's not looking forward. And right. But something significant has to be done right now. Something has to happen. I think, haven't looked too deeply into most of the candidates' plans because I don't think any of them are really too deep on what we're going to do. I mean, they're talking good talking points, but really, what are they going to do? No one really knows, except on the tax plans. And pretty much most of the tax plans, what they want to do is they want to have a flat tax or drop the income tax rates. Really, if they do that for business, that's going to do well, because basically you have a lot of companies right now that are either keeping assets outside of the United States or they're forming corporations outside of the United States. Because it's cheaper to do it. It's cheaper to domicile your business in Ireland or in the Bahamas or in Europe or in Russia than it is in the United States. And as long as you don't need to bring money back into the United States, it really hasn't been an issue. I mean, that's why Apple has so many billions of dollars outside of the United States. That's why I believe, what was it, Burger King did a reverse merger into a Canadian company because the tax rates they're getting there are going to be significantly more favorable. So a lot of the proposal that we're seeing in the Republican side to kind of have a tax holiday in order for corporations to re-domicile money back in the United States By bringing it back here, that means they can actually start deploying the money into the economy. That would actually have tangible impacts for people. That would have tangible impacts on jobs. If we give people basically a tax cut, we're going to basically go spend more money. But on a consumer side, I mean, it's kind of like in 07, 08, people were using money out of our. Why did the economy do so well in the late 90s, early 2000s? And that's because people were using the equity in their home as an ATM and going to buying iPhones and everything else that they wanted to do. So those numbers were looking bad, but they're running up their credit cards and they're sucking up the equity in their home. Then when the home prices eventually fell, that's why they created the problems. Now, after 07, we did have consumer debt numbers go down. We did have savings rates go up. Part of it is because credit was not that readily accessible. And people are basically spending less money. And that's why we had a quote unquote slow recovery. What we've been seeing though is actually, I mean, yesterday I saw a report from somewhere, credit card balances have ticked up again. So people are putting more money in their credit cards. I think the average for a family was $15,000 or so, which is ridiculous when the average family income in the United States is $35,000.
Right. So, right. That's scary. It's very scary.
It's scary, but I mean, that's what the spending is what keeps our economy going. I mean, we're a consumer spending economy. What's best for the country in the long term is to let some of the banks default to basically get a clean slate and get the savings rate up. And that's going to do well in the long term. But the model has been, as long as we put out more babies than there are people that pass away, there's going to be more and more spending and inflation. That's really what it is. I mean, if you inflate numbers, it works. I do agree with Donald Trump on one big point, though. The amount of money, imagine if we spent the $3 trillion that we spent on wars, we actually spent it on infrastructure in the United States. That's what would have a tangible impact on people. And we haven't been doing that. So.
Yeah, no, I just thought, because of our economy and the way it is set up as a worldwide economy now, it's not just the United States economy. If you have somebody who ends up upsetting other leaders throughout the world, what kind of impact would that have, about trade, about buying our bonds, about, because China, bailed us out really in 2010.
Absolutely.
They really helped us in that sense. Now they're hurting, and we probably won't help them in return. I don't know how that works, but I'm just thinking if you pissed off China and then we found that situation again, would they be apt to, willing to help us?
And probably not. I mean, they're already basically part of the reason why. I mean, at the end of the day, so when you're dealing with a client, you have their net worth, their assets minus their liabilities. America's worth pretty much nothing. I mean, we have significantly more debts. We have no reserves. The Middle East does, Russia does, China does. So China was the biggest buyer of our debt because there's almost no other place to put that money. There's no other things that were fairly safe that you can put your money away into. They started putting significantly more money into gold. And that's why they started going down the path of having their currency, the yuan, be a reserve currency with the central banks so they can actually start diversifying away from the US dollar. Now, the biggest issue that we're facing is the debt is a problem, but there's two ways we can get out of that problem. Number one is we can basically default on our debt, or they can inflate their way out and print a lot more money. And then your debt is significantly less. And basically that's going to screw the consumer, but it is a problem that somebody's basically going to have to deal with. I think that even this year, most economists are projecting that our deficits are going to grow again this year, as opposed to the past couple of years, where they actually shrank due to sequestration and a couple other things. But the size of government is a really, really big issue. Number two is we live in a quote unquote in a globalized world.
Yeah.
So even China is now the high cost producer for making toys. That's why a lot of it is going to other countries.
Right.
China is trying to go away from the export to the service type models. The problem that basically that creates as well, that's why we don't really have a lot of decent paying middle class wages in the industrial production side of it.
Right.
You have high tech production, and then you have a whole bunch of services. But
well, it's always bad, right? To when you can outsource something and make it cheaper with the shipping costs of shipping it back.
Yeah.
Now I saw I forget who did this, but I think it was like Brazil, and as these countries become, more coming out of the second world type deal, and they become, more or less not like the United States, but become more solid, economic powerhouses themselves, then their wages, their consumer wages go up for their citizens, which then that cost then is brought down. And so it doesn't make it as effective to, outsource some of those manufacturing jobs and things like that. And they'll start coming back to the United States.
Well, I mean, a lot of it's basically, a lot of the countries, we're doing the protectionist thing. So, look at, for instance, the manufacturing side of it. Why is Toyota and why is Honda, why is BMW, why are they making cars now in the United States? Because the tariffs, it's cheaper for them to basically produce it here than it would be basically from Germany, and they'll get slapped with taxes, just basically bringing the cars in here. That's part of the reason why we're moving their infrastructure to the United States. But at one point, it's always this pull, because we want to say, hey, you know what, this was proudly made in the United States, but proudly made in the United States also means that it costs more.
Right. There's a standard of quality that you're going to pay for.
Yeah, you're going to pay for it, and it's just really a balance between, hey, what do you want? Right. You can basically make things here, but it's going to be significantly more expensive, and no one wants to pay more. We want the lowest prices, and we also want it to be made in the United States. You do have a number of people who will buy a product that's made here, even though it's more expensive, because they get other benefits. Just basically just even knowing, hey, you know what, I'm supporting the economy. But the vast majority of people, they want to keep prices low.
Right.
It's the same thing. Just really kind of going back to the people who are arguing for $15 an hour minimum wage. Well, you know what? Yeah, your wages can go up, but you're not going to have the dollar stores anymore. You're going to have $2 stores now. Everything else is going to adjust with it itself.
Exactly. I don't understand the argument. $15 an hour jobs. Some people don't deserve to be paid $15 an hour. I'm sorry.
Well, I think there's already a picture of McDonald's going to just machines that you can input your orders.
Yeah, or like, sometimes people, and I think there's not enough put on this, and I don't know how to articulate this in a way, but when I started out in high school, I started working out at a job, making, I don't know, $6.50 an hour or something like that as a bellman in a hotel. And I said to myself, I'm not doing this for the rest of my life.
Yeah.
Right. But if I start out making $15 an hour and I can afford an apartment and I can, have a child at no cost and healthcare and this, there's no motivation to excel. And that's what the United States was built on is, you get what you earn. And if you start out at a high level, then you get kind of lazy.
Yeah. It's like everybody, no one wants to be the bottom. No one really wants to be at the top because you have a big target on your back, but everybody's comfortable in the middle. And I think the phenomena is it's a salary mentality. You're going to do just enough in order to get by. There's really no motivation one way or the other. But really, when you think about it, minimum wage is supposed to be minimum wage. It's there for you to get by, but it's not supposed to be there for you to be comfortable and not want to excel up or down. It's like being a waiter at McDonald's is probably not the ideal position. That's not where people foresee themselves being long term.
Right. Now, for some, I mean, there's a place for that, right? I mean, I get it. There's a place, and some people, you know, with learning disabilities, whatever, and
It's supposed to be a stepping stone, though.
it's a stepping stone for most Americans, and that's what it should be. It shouldn't be a, hey, this is your final destination at 17 years old.
Yeah,
no, it's not that. So, yeah, I don't understand, and you're absolutely correct. I mean, if it all trickles down, that just means my hamburger went from, you know, $2 or off the dollar menu into a $5 menu.
Exactly. I mean, the business owners are not. I mean, if you're that business owner, I mean, you're not gonna. Well, it's
I'm gonna.
I mean,
I'm not gonna cut my profit because I got to pay somebody that.
Yeah, I mean, or you might a little bit, but I mean, if your input cost went up twice, I mean, you're not going to be able to subsidize somebody else just because you want to do the right thing. I mean, it's the same thing. It's like, look, if interest rates went up, the rates on mortgages is going to go up. It's like, no, the banks are not in the business just to do good for somebody to subsidize it. It's a challenge, and a lot of people don't understand that. And I think there's like one article or something that I was reading where you have owners of dollar stores that basically, when they realize that, hey, you know, this person, this big company, they just raised wages for everybody. What they do is they just go back and raise prices.
Yeah. Or when you have somebody making that kind of, you know, $15, okay, I'm going to work you harder and I'm going to give you less hours.
Yeah.
So you're
going to expect people to be much more efficient.
Right.
So,
all right, man. Well, hey, good seeing you, man.
This was fun. Thank you. When's your next show?
Tomorrow night.
Tomorrow night. I'll see you on.
We are doing George. Yep. I call him Jorge. We are doing the top newsmakers in real estate for December 2015.
Fantastic. Looking forward to it.
So join us if you can.
Will do.
Cool, man. Well, good seeing you, man. Happy New Year.
Thank you. Happy New Year to you too.
And I'll probably see you next week or whatever. Let your gentleman know, or tomorrow, I suppose.